Hello and welcome to the week ahead with myself, Joshua Mahony, Chief Market Analyst at Scope Markets. Looking ahead to the new week, of course, we're still reeling from what has gone before. We saw stronger GDP numbers out of the US. We also saw elevated inflation readings out of the Eurozone. I'm recording this just before we see the US core PCE numbers. So we're going to see some likely volatility around that as well. But as we move forward, we're going to see that inflation theme really carry through into a central bank theme, in particular with the Bank of Canada and the ECB interest rate decisions coming out midweek. And then the back end of the week, of course, because it's the beginning of a new month, we have a focus on US jobs alongside Canadian jobs this time around. So let's get into it. First and foremost, the big ticket items for the week ahead. We can see we kick off with a theme around manufacturing on Monday with both Caixin and ISM numbers coming out of the US and China. We've got that jobs focus starting to feed in on Tuesday with the job openings. And we're also going to, of course, as we move through the week, see the likes of ADP, see the likes of unemployment claims. And that's crescendoing into Friday's numbers where we see the payrolls, the unemployment rate, the average hourly earnings out of the US and the Canadian jobs data as well. But midweek, that's where we're likely to see the bulk of the action, in my opinion, with that Bank of Canada interest rate decision coming out on Wednesday. And then on Thursday, the ECB interest rate decision. Both could cut interest rates, despite the fact that inflation remains above that 2% target. And we'll get onto that later on in the show. Now, first and foremost, I wanted to bring up the US. Of course, the US is so important because ultimately it really determines sentiment globally in terms of how things are playing out. So in terms of the payrolls, you can see that there's an expectation that we're going to see those numbers tempered quite significantly down to 151. You can remember not so long ago, we were hitting 300K on a regular basis. That being said, it was driven very heavily by job creation in terms of part-time roles, not necessarily full-time roles. So question marks about whether that is really just double counting for people that needed to take on a second job. But down to 151 from 175 expected. Could that bring forward expectations in terms of a rate cut from the Fed and say, hey, we're seeing some weakness from the jobs market? Federal Reserve might need to do something sooner than anticipated, coming off the back of the recent decline in terms of GDP. You know, maybe that hot US economy theme is going to ease. But we can see here that inflation pressures remain prominent. 3.9% expected for the average hourly earnings, remaining the same compared to last time around with the 0.2% reading expected. Elsewhere in the week, you can see here, we don't have the estimate for the ADP number quite yet, but the expectation is that we're going to see manufacturing potentially move back into that 50 threshold, which could be a bit of a headline maker. On Monday, we've got the likes of the services PMI, again, expected to rebound significantly up to 52 from 49.4. So, you know, if we're talking about the potential weakness around, say, the GDP number and potential weakness around the payrolls number, you've also got to temper that against the possible rebound that we're seeing for both of those ISM numbers. So we could see some risk-off sentiment coming into play at the beginning of the week, given the whole, you know, good news is bad news is good news when looking in relation to equity markets at the moment. And so I wanted to take a look first and foremost at the equity markets. Let me just quickly bring it up here. So I wanted to bring up the Nasdaq. Bear in mind that we were looking previously at the likes of the Dow Jones Industrial Average, and the Dow has essentially been the big underperformer in no small part because of the fact that it does not have Nvidia. And Nvidia, of course, strong earnings, and then it's been doing really well since then. That's tempered somewhat now. And you can see here in terms of the Nasdaq, I mean, out of interest, let's see if we overlay Nvidia. So yeah, I mean, you can see that it's pretty much perfectly tracking the price of Nvidia, right? So as soon as Nvidia sort of peaked out and started to roll over after its recent post-rally rise, that's where we've started to see this market heading lower, and it's expected to head lower into the weekend as well, with markets looking for a negative open on Friday. But you might have already seen that by now. So in terms of the Nasdaq, what are we looking at? So we've seen a pullback here, and crucially, we've now finally broken down through your key area of support that we have here, which is at 18550. That points towards a wider pullback coming into play here for the Nasdaq. Near-term support comes from prior resistance, which is around about here. So 184.10 up to sort of 184.60, that zone of prior resistance. So if we manage to clear that level, then there's a possibility of a further period of downside to come into play. Of course, like I said, right now we're in a sort of bad news is good news is bad news. So if we were to see weak economic data, it would likely lift this market because it might bring forward the expected interest rate cuts from the Federal Reserve. We're likely to see some volatility around that PCE number, like I said. But ultimately, you're looking at a market that is a long-term outperformer. So the trend is your friend, but right now we're seeing a potential bearish engulfing. So that points towards a possibility of a counter trend pullback. How far is that going to go? Well, look, what have we seen in the past? You see here, big bearish engulfing. Well, it just recovered it entirely the next week. That can happen. What do we see here? 4 weeks in a row of downside. So the depth of the pullback is the difficult part to judge, quite frankly. And so I wouldn't necessarily just be jumping into this blindly. I'd be looking for potential bullish reversal signs if I was looking for bullish positions, or else for short-term downside positions to continue this pullback. You'll be looking for, similar to what we've got here, a breakdown through the price swing low following a relatively shallow retracement. That means that your stop loss can be quite tight above that price swing high, and then just look for an extension towards the downside off the back of that. But generally, I don't necessarily like the sort of counter trend play too much. But, as I said, the near-term trend on the intraday based on that 4-hour chart has ended with a breakdown through 185.50. So until we see a short-term rally up through your price swing high, then it looks like this sort of bearish trend looks like it could be here for the time being. And that jobs report on Friday and those PMI numbers earlier in the week should be absolutely key. In particular, if we see a big pop in terms of those PMI numbers, I think that could be concerning. We could see some near-term selling coming into play for the Nasdaq. So certainly one of the most notable markets to be keeping an eye out for at the moment. Now that Nvidia's stopped supporting this market, it's starting to come down in a pretty meaningful manner. Okay, this is just an overview of what we're looking for in terms of the jobs report itself, not necessarily what we're looking for, but the trends. And what you can see here is, first and foremost, unemployment has been gaining some ground, but it's not necessarily anywhere to worry about. You look at essentially at pre-pandemic levels. Participation rate, a similar kind of story. Non-farm payrolls, you can see, yes, we saw some strength recently, but despite the fact that it's coming down at the moment, I would say between 100K and 200K isn't a problem. It's essentially back to where we were pre-pandemic. Average hourly earnings moving in a downward trajectory. In particular, if we see, as is expected, the average hourly earnings stay flat, then that could be a warning sign, because that, of course, wages are a key element that go into sort of underlying inflation pressures. So keep a close eye out for that average hourly earnings number in particular. And then let's look at the Eurozone. On Friday, we saw the latest Eurozone inflation data coming out. I mean, quite frankly, it was a surprise, because we had actually seen some pretty low figures in terms of the numbers from different countries within the region earlier in the week. But ultimately, we saw the month-on-month coming in at 0.2 rather than 0.1. We saw the core and the headline both moving upwards, more so than expected. And it raises question marks about not necessarily this meeting, because essentially all the members from the ECB have been coming out and saying that they're going to be cutting interest rates at this meeting. But where do we go from here? It wasn't long ago that we were hearing, at the beginning of the week just gone, we were hearing about the possibility of a July rate cut as well. But that looks unlikely, given the upward trajectory of inflation. It's something I have been pointing towards in my sort of breakdowns for both the ECB, but also for the Eurozone inflation figures that I released recently. Ultimately, we are at the beginning of a period where we're going to see inflation rise. And so those expectations of, say, a third rate cut this year, I think they're very unlikely. And so we're looking at a potential repricing of that. It's not necessarily this meeting. So what's going to be interesting for this meeting is, do markets get carried away about the fact that we're seeing this 25 basis point cut? Potentially. But then you might see that initial move fade. If they do cut, you might see that initial optimism fade when we see Christine Lagarde coming forward and essentially starts to sort of downplay the idea that we're going to see 3 rate cuts this year. And we can see exactly what the market expectations are at the moment. 93% expectation of a rate cut this time around. Where would we see the next one beyond that? Well, it's pretty much a coin toss for September. So September, a distinct possibility. And then if you look at December, well, December, are we going to see a third rate cut? Well, market's currently pricing it around 35%. That not long ago was 50%, right? So it's gone from a half to a third. And I think that's likely to continue to shift out. I think it's a 2 rate cut year for the ECB. And so that repricing around that back end of the year is what could move the markets beyond that initial announcement if they do decide to cut rates, which 93%, it's very likely that they will cut rates. If they don't cut rates, this time around, given that, it's only a 7% expectation for that, you would likely see some significant euro strength and some significant weakness in terms of the likes of the DAX and the CAC and some of those mainland European markets. So let's look at a market for this. We're looking here at euro dollar. Euro dollar from a weekly perspective looks really interesting because what we've seen is this downward trajectory, certainly on the top end of price action, and the rally recently taking us up into both the descending trend line, but also of this 76.4 Fibonacci retracement at 1089. And we've been respecting it absolutely perfectly. It's the 3rd week in a row that we've been doing so. So does this mark another top before we roll over? A dovish outlook from the ECB could do that. And certainly if we do see weak economic data coming out of the Eurozone, if we were to see inflation moving towards the downside, which, like I said, I don't think is going to happen, then that could provide that downside move for the euro. Also, when we first see that rate cut, if it happens, we could see some weakness coming into play for the euro. But I do think there is a risk for the near term. And the risk is that we see them essentially push back on the idea that we're going to see a rate cut at the back end of the year. And so we'll just see 2. And so maybe we see a bit of risk off coming into play, which benefits the dollar. But really, we've got to break through trend line and Fibonacci resistance to exit this phase. And if we do exit it with a breakthrough 109, then it looks like possibly we're going to see another leg higher for this market. But for the time being, the bearish trend does still remain in play. And yes, we're strengthening towards the back end of the week because of that inflation readout that we've seen from the Eurozone. But until we break the 109 level, this it just continues to sort of knock on that 76.4 fib and could still roll over to continue that wider bearish trend here for euro dollar. And finally, I wanted to bring up, there it is, data out of Canada. Now, we have got a whole host of numbers coming out. We've got particularly a whole host of PMI numbers coming out at the beginning to middle part of the week. But everyone's going to be focusing on that Bank of Canada interest rate decision on Wednesday. Markets are expecting a rate cut from the Bank of Canada. We're also at the back end of the week going to see the jobs report with an expectation that we see flatlining unemployment at 6.1%, but a collapse in terms of that employment change number down to just 5K from 90.4K. And certainly, if we do see weakness in terms of the Canadian economy, then you're looking at the possibility of people feeling more dovish or thinking the Bank of Canada will have to do more. Bearing in mind that this comes off the back of a stronger than expected GDP number coming out of Canada. And so, that could allay some of the hopes, I guess, that we're going to see interest rate cuts coming into play from the Bank of Canada over the near term. But ultimately prices, markets at the moment are pricing exactly that. You can see 64%, 64, 65, expecting a rate cut on the 5th of June. And then from there on in, Well, it looks most likely that we're just going to see one more rate cut this year, essentially. And that rate cut currently is priced in for a coin toss for September, but more likely for October. So the back end of the year, essentially for a second rate cut from the Bank of Canada. But this time around, it's a little bit more dicey because, of course, while you're looking at, what was it, 93%, we're looking for the ECB. This time around, 65% to 35%, so 2/3 to 1/3. So it's not guaranteed. That should bring significant volatility for the Canadian dollar. We can see here in terms of inflation. Now, what's important is that the Bank of Canada typically looks at inflation in terms of targeting that 1% to 3% range. Of course, 2% is central to that, but they do allow fluctuations within that. That means they're not necessarily going to be as tied to the idea that they have to hit 2% to be able to cut interest rates. And that's why, to a large part, markets are expecting it. But you can see recent months inflation, as we see in the middle, last 3 months, we've seen a significant uptick. And that's what's driven that 6-month annualized reading significantly higher. So inflation has reared its head recently, but that is something we've seen across the globe, and a number of countries have managed to drive it down. Ultimately, you're looking at the possibility that, this is a short-term sort of bump in inflation at the beginning of the year, and it starts to ease off, as we've seen elsewhere. And that should embolden people to think that we're going to see further easing coming into play for the Bank of Canada. The fact of the matter is that if we've got 65% priced for a rate cut, then that means that a rate cut can still actually do some damage or can still have a significant impact on markets. So this is the Australian dollar against the Canadian dollar. Let me just full screen this. Aussie CAD. So wider trajectory shows, look, we're in a long-term downtrend, but the current phase that we're in is a recovery phase, right? I mean, for all we know, this is a bottom because we're flatlining down here. So is this a really long-term bottom? Potentially. Now, we have broken up through resistance here, and so we don't necessarily know how long this current leg is going to rally for before we potentially pull back once again. But what we do know is that the trend is still in play, because as you see here in the daily time frame, we've got this this recent pullback where we have not broken the price swing low, which is 0.9 essentially, and we've pulled back into, let me just see if I can just shift that into a deep zone. There you go. We've pulled back perfectly into the 61.8, and we've hit it on one, potentially two, three, four or five times now on a daily basis. We've found our low at this 61.8 Fibonacci level of 0.905. So look, the Australian Central Bank, the RBA, are unlikely to cut interest rates at all this year. And so with markets pricing a 65% chance of a rate cut, if we do see that rate cut, I think this could mark a potential bottom in a run up for this currency pair. We're looking here in terms of price action, and we're sort of bottoming out but creating higher highs. I think there's a good chance that we do see the bulls come back into play if we see the Bank of Canada cut interest rates. Yes, we came up with a stronger number in terms of the GDP number, but also the back end of the week, we have got the jobs report. So that gives us the potential basis for weakness if we're looking at that weak employment change number. So look up for the 61.8 at 0.905 as your near-term support level. But certainly for me, I think this is sort of basing out at that level. And I think the bullish trend that has been playing out of late looks like it's probably likely to continue as we move forward if we see the Bank of Canada cut interest rates. If they don't, of course, 35% chance that's happening according to market pricing, then we're likely to see this pair move towards the downside with the breakdown through that 61.8 Fibonacci level, particularly notable if that happens and pointing towards a deeper pullback. But ultimately, I'd need to see a breakdown through this sort of 0.9006, essentially 0.9, to essentially call an end to the trend that has been playing out over the course of the past, how long are we talking, sort of mid-April and essentially the entirety of May. So, near enough a month and a half that we've been on this latest run. At some point, we're going to pull back, but we haven't seen that signal quite yet. And the 61.8 has been providing us with great support as we move into a week that is going to see Canada really dominate.